That's a great question, and it's a question that we've been getting a lot from our investor base. When you look at the last 5 years, the last 5 years have been characterized by very low confidence, very, very poor headlines, and low returns. Business confidence is currently sitting at 40-year lows. And if you do an analysis of returns on the JSE over the last 40 years, the rolling 5-year returns that you would have earned over the last 5 years has been amongst the worst that we've seen over 40 years. And the natural tendency would be to actually sit in cash until some of these uncertainties clear. However, we would be cautioning against that. We think when prices are this low and uncertainty is this high, there's often great opportunities for generating good future returns. And if you go back in time and see, subsequent 3-year annualized returns from, periods which we've seen in the past, characterized or similar to what we're seeing at the moment, it's been characterized by, very good above average returns. We think the biggest risk at the moment is capitulation, where investors give up on higher equity type funds or sell out of equities and move into cash. In our funds, we've actually been deploying cash over the last year, given the favorable return outlook. We do think there's a standout opportunity within South African assets. That's both equities and bonds. And we get often asked the question, given our positive outlook, I guess, in certain parts of the South African investment landscape, how do we mitigate some of those downside risks? There are a number of scenarios that might materialize within the South African investment landscape, but we can focus on two primary risks or scenarios. One is a muddle-through scenario, somewhat similar to what we've seen over the last couple of years, which has been characterized by policy stagnation, low growth, lots of uncertainty, low confidence. And in that type of scenario, your starting yield is incredibly important in these type of low return type environments. And significant portions of our funds are allocated to higher dividend yield stocks and to bonds where your starting yields are north of 10%. And that sets you up for good future returns if this type of scenario does materialize. We then also need to consider what people will talk about as a low road scenario, where we see further deterioration in governance structures, growth, and or policy outcomes that aren't favorable for the investment environment. And there are a number of levers one can pull in one's portfolio to try and offset or mitigate some of that risk. The first thing is that just from a PSG asset management perspective, we're not all in South African securities. If you look at our funds, we generally have a high weighting offshore assets in our high equity funds and our multi-asset funds. It's somewhere between 28 and 30% of our funds are sitting in offshore securities. We also still have some cash balances within our funds, which will give us some firepower to deploy in future scenarios or to act as a buffer against downside asset performance. We also do have some rand hedges in our funds. So if you look at our PSG Flexible Fund as an example, somewhere between 10 and 15% of that fund is sitting in rand hedge shares. So we are positively disposed towards South African securities. We do think there's a great opportunity, but we've balanced that with a number of other asset classes and geographies, which would mitigate some of the downside risks associated with investing solely in South Africa. We don't explicitly forecast expected returns over rolling periods in the future, but what we can say is, given where prices are in terms of being characterized as being very low in South Africa, in certain parts of the market, and we reference the bond market, where we think there could be equity-like returns at low levels of risk, and in the SA Inc. type shares, particularly in the mid-cap space, where we think that the chances of generating above average returns in the future is high. And thirdly, where we have been deploying cash over the last year so we've moved from cash into equities and bonds, we would think that the return profile for our funds looks pretty favorable over the coming years. And the chances of generating mandate or above mandate returns has increased, particularly over the last 6 months, given that prices have come down in the overall markets.